We'll go to accounting chapter 13. Irrecoverable debts and provisions for doubtful debts. Debt means that you are being owed. Some customers are owing your business. That is it. So how does it really start? It means you have sold on credit to your customers. And when goods are sold on credit, it means customers are allowed to pay at a later date. That is what selling of goods on credit means. Then there comes the risk. What is the risk of selling to customers on credit? The risk is that some customers might not be able to pay back. Reason being that maybe they are out of business, or they are unable to pay, or they disappeared. Do you get what I'm saying there? Yes. So there's always a risk when you sell goods on credit. So this is where irrecoverable debts and provision for doubtful debts comes in. So let's go down. Introduction. When goods are sold on credit, the customer is allowed to pay for the goods at a later date. There's always a risk that customers may not pay for those goods. That is what we're talking about. So an irrecoverable debt is an amount owing to a business which will not be paid by the credit customer. So we call it irrecoverable because you cannot recover that debt. The credit customer will not pay back. So it's gone. So you have to pay, you have to sort it yourself. Yes. That's why it's called irrecovered debt. So this may be because the customer has disappeared. That means you're not even seeing the customer. It's gone on ticket. You can't find the customer anymore. Or has gone out of business. He's no more in operations. Or because he's unable to pay. So these are the reasons why there's what we call irrecoverable debts. So if all reasonable steps to obtain payment are failed, then the debt is written off. So if you try all means possible to recover these debts and it's not coming forth, then it becomes a debt written off. It's off. It's bad debt. Bad debt written off. Because you've tried all possible avenue to recover the debt, but it's not coming forth. It's gone. Is it clear? Yes. Now, if unreasonable accounts, if unreasonable steps, okay, we talked about that. So the account of the customer is closed by transferring the amount written off to the irrecoverable debt account. At the end of the year, the total of the irrecoverable debts account is transferred to the income statement where it's carried as an expense for the year. So, how do you make provisions for this? So you have to open an account for it. The customer, the customer has its own account. Let's say ABC Limited bought for you on credit. So in ABC Limited, it has a debit entry, yes or no? But now the debt is irrecovered. So you have to credit the other side of that customer's account. Yeah, for the irrecoverable debts. Because you're going to open another account. No, before opening that. Oh, yeah. The customer's account has to be canceled. You have to close the customer's account. Yes. The ABC Limited bought goods on credit from us. In ABC Limited's account, there's going to be a debit for that goods bought on credit. Goods bought on credit, yes. You've debited ABC Limited account. Now, the debt has gone so bad, it's not recovered. It's a bad debt written off. So you have to credit ABC Limited's account to balance off that account. That is the first step. Yes. Clear? So look at what they said. The entries are summarized as follows. When the debt is written off, credit the customer's account and debit the irrecoverable debt account. Yes. So first, the customer's account has to balance. Then you go to irrecoverable debt account, which you have to open because the debt has gone bad. So you debit the irrecoverable debt account with that amount. Is it clear? Yes. Good. Then at the end of the financial year, you credit the irrecoverable debt account and debit the income statement. So at the end of the financial year, you have a lot of, maybe you have different irrecoverable debts. Yeah. Okay. So all those irrecoverable debts, you record them. At the end of the year, you credit the irrecoverable debts account with the total and your income statement. They become expenses. You get it? So irrecoverable debt is what? An expenses for the business. The business has to pay for it because you have to balance your account. Is it clear? Yes. So written off irrecoverable debt is an example of the application of the principle of prudence. If a debt cannot be regarded as an asset, it is written off so that the assets are not overstated. Normally, a debt is what? Is a credit, it's supposed to be a current asset. Yes or no?
Yes.
Those are your debtors. Those are your trade receivables. But if you cannot record that trade receivable, it becomes a bad debt written off. Do you get what I'm saying here? Do you get it or not? No. As soon as goods are sold to your credit customers, they become trade receivables. Yes or no?
Yes, sir.
If you are unable to record it as your trade receivables, that becomes a bad debt written off. So it's either you record it as trade receivable or a bad debt.
The same thing.
Yeah, it's the same. It's either it's in trade receivable. If it is trade receivable, that means you're going to be able to recover your debt. Your debtors are going to pay. That is why it is an asset. But if it's not going to be an asset, then those goods you sold on credit becomes a bad debt written off. Is it clear?
Yes.
So we have to apply the principle of prudence. What I'm saying is that you can, because the debt is written off. If the debt is written off and you are not recording it, it becomes a problem. You're going to overstate your assets. As soon as goods are sold, I think I started that for that. Yeah. As soon as it's sold on credit,
yes,
you will be expecting payment to be made. Yes or no?
Yes.
If this payment is not made and you left it to be as assets, then you are overstating your assets.
So where
you have to open an irrecoverable debt account.
No, I thought you don't say about some stated financial position. No.
No, yes.
Yeah, said financial position.
Yeah, if as soon as your goods is sold on credit, as soon as you have a credit customer, it goes straight to your statement of financial position as debtors or trade receivables.
And the non-current assets.
Current assets.
Yes, the current assets.
Current assets. Because customers have to pay back within a year. So if customers do not pay back within a year, it becomes an irrecoverable debt. That means you have to open an irrecoverable debt account. But before you open that irrecoverable debt account, remember you have an account for the customer already. So the debit side has their customers' purchases. Now that the customer is not paying back, you have to close that account. And as soon as you are closing that account, you have to open irrecoverable debt account. On the debit side, you post the amount that is not the bad debt that is written off. So it means it's going off your statement of financial position. That is how you do your account. If the debt is going to be paid, if the credit customer pays, it's part of your financial statement. Yes or no? And it goes to your cash book.
Yes.
But if the debt is gone, if the debt goes bad, it has to be written off. It becomes an expenses for the business. So the first thing you have to do is you balance the customer's account as bad debt written off to cover up, to balance the account. As soon as that account is balanced, it is off your statement of financial position. It is now in your irrecoverable debt account and income statement as expenses, bad debt, irrecoverable debt. Is it clear?
So it's not in the statement of financial position.
It will not be there anymore.
Yeah, after
because the debt has gone bad.
It was trade receivable in the statement of financial position.
Yes.
And then after the recoverable debt.
If it is not recovered,
yes,
if it is known, all steps has been taken, and the customer is not coming forth, then it is a bad debt that you have to write off. And how do you write it off? You open an irrecoverable debt account, stating the amount there. And then your income statement, it becomes part of your expenses. If you do not do it that way, you would have overstated your assets. And if you have overstated your assets, it means you are not following the accounting principle of prudence. Prudency. Is it clear? Is it clear?
Yes.
Okay. So, they said, written off recoverable debt is an example of the application of the principle of prudence. If a debt cannot be regarded as an asset, it is written off so that the assets are not overstated. The bone of, in summary, when a customer as soon as the customer buys from you on credit, the customer becomes a trade receivable. If the customer do not come forth, if the customer doesn't pay back as at when due, the debt becomes irrecovered. it has to be written off. That is bad debt written off. The customer's account, the first step is you close the customer's account on the credit side as bad debt, and you open irrecoverable debt account, which will be debit, which will have a debit entry. Then the balance on the debit entry goes to your income statement as expenses. That is how you close irrecoverable debt account. Clear?
Yes, yes.
Good. So if you have done that, it means you have applied the principle of prudency. Because if you do not apply the principle of prudency, you would have overstated your assets. And overstating your assets might tempt you as the owner of the business. When you have overstated your assets, you would be having more profit and you might be tempted to spend more. And also your financial statement is not reliable. Clear?
Yes.
Okay. We go to recovery of debt written off. A debt written off may be recovered if a credit customer pays some or all of the amount owed after the amount was written off. So, irrecoverable debt, the debt that is written off might be paid back. That is, maybe the customer finally shows up. For example, maybe the customer disappeared.
Yes.
Now he's reappearing. So, if he's reappearing, that means you are able to recover your debt. Clear?
Yes.
So, what do? Now that you can recover the debt, it said, as the account of the customer has been closed, the amount received is debited in the cash book and credited to a debt recovered account. Because you have closed the customer's account,
Yes.
so that is done. You can't reopen that account anymore. The only thing you do is you go to your cash book account to record the amount, and you credit the irrecoverable debt account.
The cash flow.
Did you get what I said? No, you don't get it.
Credit.
Two things are going to happen.
Yes.
If the debt is not recovered, when the debt is not recovered, when the debt wasn't recovered, you open irrecoverable debt account. Yes or no?
Yes.
Good. Now that you've opened irrecoverable debt account, the next thing you do, finally the customer shows up. Let's assume the customer disappeared.
Yes.
Now he's reappearing. As soon as the customer reappears, it means that the customer wants to pay the debt. That is recovery of debt written off. Get it? The customer reappeared.
Yes, yes.
So because the customer reappeared, it means the customer wants to pay.
Yes,
If he's not going to pay, he won't come back. He came because he's here, he has showed up because he wants to pay. What will you do? How do you post these accounts now? Note, you have closed the customer's account already.
And you did the irrecoverable debt.
Yeah, as bad debt written off
Yes.
on the credit side.
So
that account is done.
Yeah.
That account of that customer is done. Now, how do you post it? Because it has to have two entries too. Yes or no?
Yes.
The two entries are one, the irrecoverable debt account that has a debit entry will now have a credit entry as recovery debt or recovered debt for that amount. That irrecoverable debt account is balanced. Yes or no?
Yes, yes.
Now, the amount payable or the amount that is being paid will be recorded in your cash book. Then the account is done.
Debit side.
On the debit side. So it
As
erased the expenses now.
As a recovery.
Yes.
Record as a recovery debt
Yes.
in the cash book.
In the cash book. Is it clear? So the amount you receive will be entered by debiting the cash book and crediting the customer's account.
That's during the year, right?
During the year, yes.
But,
It paid. The customer paid, right?
Yes, yes.
So at the end of the year,
Yes.
what do you do with it? You record it as what? As at the end of the year?
Yes.
Okay. At the end of the year, your income statement, you credit your income statement with that amount.
Yes, yes.
You credit the income statement because now you have received the income. It's no more expenses. It becomes an income.
Wait, repeat. At the end of the year.
At the end of the year. At the end of the year, you credit your income statement.
So, yeah.
As income.
Yes, yes, as income, yeah.
When it was bad debt written off, it is an expenses. You debit your income statement with expenses.
Yes, yes.
But at the end of the year, that the customer paid back, recover debt, right?
Yes, yes.
It's a credit entry now in your income statement.
It's
Remember that in your income statement, the credit entry is always income.
Yes, and
The debit is expenses.
Yeah.
So now that the recovered debt is an income. So it has to go towards the credit side now. So that's the end of the year. Is it clear?
Yes.
So we go on. Okay, we have a question now. I think it's going to be better now. Sachin is a trader who sells goods on credit. Sells goods on credit. He offers customers a cash discount of 2% if accounts are paid within 30 days. Sachin's financial year ends on 31st of December. Sachin sold goods for $100 on credit to Bufan Stocks. The account was settled by check on 28th of February. On this day, Bufan Stocks purchased further goods of $150 on credit. After many attempts to recover the amount due, Sachin wrote off Bufan Stocks account as an irrecoverable debt. So there's $150 irrecoverable debt. Yes or no?
Yes.
Sachin received a check from Bufan Stocks of $150 on 31st of October 23.
For the next year.
Yeah. After the debt was written off. So now, for Bufan's account, Bufan is the credit customer, yes or no?
Yes.
In Bufan's account, we're going to have a debit entry for the sales for 400 and 150, yes or no?
Yes, yes.
So the total bought in terms of goods on credit were 550.
Yes.
Great. Now, Sachin paid for the amount owing before the 30 days, before the due date, yes or no? So Bufan is entitled to some discount. Sachin will have discount receipt.
Yes, sir.
Yes or no? Of I mean of 2%. So that means 2% of 400 was paid, 392. Yes or no?
Yes.
Then discount is $8. That's the amount. So, but that's not the total amount paid. There's a bad debt written off, irrecoverable debt. Yes or no?
Yes.
Which was 150. So that is the total. The total owed was 150 or 550. The total paid was 400. We have irrecoverable debt of 150. So we open irrecoverable debt account. On the debit side of irrecoverable debt account, we have the Bufan Stocks of 150. On the credit side, which is income statement, we have 150. That is done. Yes or no?
Yes.
So 150 is going to your income statement as expenses. Clear?
Yes.
Now, what happens afterwards? There's debtors written off. There are other debtors, I think. Which one?
820.
During the year, Sachin wrote off income debt totaling 820. So not only Bufan stock that Sachin is owing, not only Bufan stock that is owing Sachin, there's another 820 during the year. During the year ended 31st, 23. Sachin wrote off income debt totaling 820.
So overall,
the total of all debt written off we are 820. Do you get that?
yes, yes, yes.
It's clear, right?
Yes, it is, yeah.
The total, aside Bufan stock is 150, but the total of bad debt written off is 820.
Yeah.
So 820 will be recorded in the statement of financial position as expenses. Clear?
Financial position, no.
Statement of profit or loss. Income, yeah, statement of profit or loss.
Yes, yes.
The profit or loss account has expenses. So it's a statement of profit or loss.
Yeah.
Is it clear?
Yes, 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 yes.
Okay. So for Bufan stock, now they said debt was recovered. So if the debt is recovered, remember that we have irrecoverable debt account. Now we open a debt recovered account. On the credit side, we have Bufan stocks for 150. Yes or no?
Yes, yes.
Okay. That's all about the transaction and it's all. So now that 150 is being paid, you take away 150 from the total of irrecoverable debt. So remember that in your income statement, we're having irrecoverable debt of 870. 820. Now that 150 is paid, it will be irrecoverable debt will be 820 minus 150. So the total that will be in your income statement, the profit and loss section will be 820 minus 150. So that is the total of irrecoverable debt.
Yes.
Is it clear?
Yes.
So we go to reducing the possibility. Are you there?
Yes.
Reducing the possibility of irrecoverable debts. The only certain way of avoiding irrecoverable debt is not to sell goods on credit. The only way you would not have irrecoverable debt is when you don't sell on credit. That means you don't have credit customer.
Yes.
But is it possible to sell on credit? I doubt it. Let's see what they said. They said all possible steps must be taken to avoid irrecoverable debt. Before allowing credit to a new customer, credit references should be obtained. If you want to avoid irrecoverable debts, especially when you have new customers. Whenever new customer comes, before you sell to them on credit, try to get their credit references from different suppliers because they have other suppliers before you. New customers will come to your business, definitely. So when they come, they might request for credit supply. Before you sell to them on credit, request for their credit references from their previous suppliers.
Yes, yes.
Do you get my point or not?
Yes, yes. So yeah, you have to ask for the previous suppliers that
If it's difficult for you as a business to not to sell on credit, it's difficult for a business
exactly.
not to sell on credit.
Yes, yes.
It's difficult not to sell on credit.
Yes, yes.
You might be losing customers. You don't want to lose customers.
Yes.
Okay, but for those customers you know already, they are fine. But whenever you have a new customer, you don't just sell immediately to that customer on credit. Don't sell on credit immediately to those customers because the credit might be, the debt might go bad. So what do you have to do as a business? When a new customer requests for a credit facility from you as a supplier, the first thing you have to do is request for their credit references. You're not going to be their first customer, first supplier. They would have had different customer suppliers. So tell them, request for their credit references from their previous suppliers.
You want to know his background.
You want to know the background. Do a background check on who they used to buy from on credit previously. So that will give you a hint. That will give you hints about their credit worthiness, or if they are credit worthy or not. So that is the only way you can avoid debt going bad. Is it clear?
Yeah.
So it's a form of credit control. So here they said, one from of the customer's bank or one from a present or previous supplier. Also, you could ask from the bank. Maybe they used to take loans from the bank. So if the bank is telling you that, oh, customer A is always paying back when it's due, is credit worthy. But if they are unable to provide you with a credit reference, it means they've defaulted. They have messed up with different credit customer suppliers before they switched to you. They switched to you because they couldn't pay some debts. So that's a form of credit control. Is it clear?
Yes.
All right, that's the point there. So invoices and month-end statement of accounts should be issued promptly. The sales ledger account should be carefully monitored. Any overdue account should be investigated and the customer contacted by letters, emails, and telephone calls, if necessary. No further goods should be supplied until the amount due is paid. Don't give customers another goods when they've not paid for the previous ones bought. These are the ways you can do your credit control. And when you know the account is due, put a call through immediately. Don't waste time. Is it clear?
Yes.
Some businesses may make use of factoring and invoice discounting, but these are outside the scope of the syllabus. There's what we call debt factoring. But that is not part of this, but let me just explain it a bit to you.
Yes.
Debt factor means you have a debt. Businesses, they said, some businesses may make use of factoring or invoice discounting, but these are out of the scope of the syllabus. When debt wants to go bad, businesses might use debt factors. These are agents, these are businesses too. They are experts of recovering debts. So what they do is this. If business A is owing you, if customer A is owing you $1,000, those debt factors, agents or businesses or firms, what they do is they come to you, they negotiate that debt. The value is 1,000. They will tell you that they will give you $800 instead of 1,000. So they buy the debt of that customer from you. So they will recover the debt from that customer. We call them debt factors. Do you get what I'm saying here? There's a debt.
Yes.
There's a customer is owing you $1,000. The debt is already going bad. The customer is not coming forth, it's not paying. Yes. So there's what we call debt factoring. So these are businesses, these are companies, these are enterprise that deals with buying of debts. They negotiate with you, the supplier, they negotiate with you. You give them some discount about the debt, they pay. Then they find a way of recovering that debt from that customer. They're not going to pay you full value of your invoice. They're not going to pay you full value of that amount owed. So instead of paying 1,000, they might pay 850. So they will find a way of recovering that debt. But you as a business, you like, instead of losing all this amount to expense, it's better you take it. So that's what we call debt factors. Is it clear?
Yes.
Or invoice discounting. So invoice discounting means you just negotiate with the customer. Okay, you can't pay this. How much can you pay? Do you get it?
Yes.
So these are the ways you can recover the debt. Yeah?
Like better than nothing.
Better than nothing, that is the point. So we go to provision for doubtful debts. The provision for doubtful debts is an estimate of the amount which a business will lose in the financial year because of irrecoverable debts. So as a business, there's irrecoverable debts. There's irrecoverable debts, which is different from provision for doubtful debts. Listen, there's irrecoverable debts. This is the debt that cannot be recovered. It is written off. The debt goes bad. That is irrecoverable debts. Now there is provision for doubtful debts. Provision for doubtful debt is also an expense. It means that you as a business, you are setting aside certain amount of money to pay for those debts that will not be recovered. You get it? So you kept this amount. You make an estimate of you make an estimate on the value that you might lose because you've sold on credit to certain customers at the end of the financial year. That is provision for doubtful debt. Is it clear? So here they said, a provision for doubtful debt is an estimate of the amount which a business will lose in the financial year because of irrecoverable debts. Is it clear?
Yes.
So at the end of the financial year, many businesses try to anticipate the amount which will be lost because of irrecoverable debts. This ensures that the profit for the year is not overstated, and the amount of trade receivables in the statement of financial position is shown at a realistic level. So look at these two things here. You don't want to overstate your profit, and you want your financial statement to be realistic, to be reliable.
Yes.
So that is why it's important for you to keep or to set aside certain amount of money as an estimate of the amount you could lose because of trade receivables. So if you are keeping that aside, you won't overstate your profits. Is it clear?
Yes, yes.
That is the point. So if you are doing this, it means you've applied the principle of prudence. Prudence. Is it clear?
Yes.
Okay. So a business also observes the principle of matching. The amount of sales for which the business is unlikely to be paid is regarded as an expense of the year, which those sales are made rather than expense of the year in which the debt is actually written off. So it means that you won't be recording sales for debts. You are going to match sales based on the income that comes in. You're going to match expenses based on the income that didn't come. Sales will be matched with income. Expenses will be matched with income that never came in. That is matching concept.
How is it sales and income?
The sales you sold, you will match it with the amount of money you are able to make from the sales you made. And the expenses will be matched with those income that you are expecting that didn't come in. If the income comes in, you match it with sales. It's fine. That is matching. We call it matching concept. But if these sales that you sold, the income did not come, it becomes provision for doubtful debts, or it becomes irrecoverable debts. Yes or no? So you should match it with what? Expense.
Yes,
at that point in time, you are not going to overstate your profit. Is it clear?
Yes, yes.
So that is the point I'm making. So in order to make a provision for doubtful debt, it is necessary to estimate the amount of irrecoverable debt. The amount of the provision for may be established by looking at each individual credit customer's account and estimating which one will not be paid. So how do you estimate this value? You can estimate it based on maybe the background of those customers to predict which one amongst them will not pay back. 2, estimating on the basis of past experience, the percentage of their total amount owing by credit customer that will not be paid. So you can also estimate it based on your past experience, like, oh, the last year, 4% of my credit customers did not pay back. So this year, let me just put it at 5%. Or let me still leave it at 4%.
Yes, sir.
The third one, consider the length of time debts have been outstanding by means of aging schedule. A provision of a higher percentage may be made on older debts. The longer a debt is outstanding, the greater the risk it may become irrecoverable. So you can also check the length, the period at which these debts were not recovered. Because if the debts are not recovered for a long period of time, they go bad. So you check if maybe after 3 months, you wrote it off, but the customer surfaced again. That, oh, the customers always come back. But they might not come back, they might not come back soon, but they will come back. So how long do they come back? So that could also determine the amount of the estimate you could make for provision.
Said Asian.
Yeah, long, how long?
I think the age of that.
Yeah, how long does it take for the debt to be recovered or not to be recovered? So if the debt is aging, it means it's taking a longer period of time. So that means it's going to go bad. You have to write it off.
Yes.
Do you get it?
Yes, sir.
Okay.
I think it was aging, like middle-aged people.
No,
Yeah.
aging means that it's getting
older.
older. So this is where we stop. Clear?
Yes.